Let me tell you a story. I want you to picture two people. They live in the same city, make the same money, are the same age. They probably even nod at each other in the elevator. Everything is identical. And then early 2020 hits, and the market absolutely tanks, down 34% in just over a month. And right there, at that exact moment, their two identical lives split into completely different universes.
So let's meet them. We've got person A and person B. Before the crash, you couldn't tell them apart on paper, but what they did before the storm hit, well, that created a wealth gap so massive it's hard to believe. And that's exactly what we're going to break down.
So this is person A. When the world went sideways, he had basically zero cash saved up. He was juggling thousands in high-interest credit card debt, and his 401k? Well, it was basically a lottery ticket on a few big tech stocks. So what do you think happened? He got furloughed, the panic set in, and he hit the big red button, selling everything at the absolute worst possible moment. He instantly locked in a $40,000 loss. And today, he's $180,000 behind where he would have been if he had just sat on his hands and done nothing. Now let's flip the coin and look at person B. Same crazy market, same 34% nosedive, but her story is the polar opposite. She just kept going. Her automated investments continued, buying up more and more shares while they were on a massive discount. She even used the chaos as a brilliant opportunity to do a Roth conversion, which is a super smart tax move we're going to talk about later. See, the crash didn't destroy her. It actually made her richer. And here's the key takeaway. It wasn't the crash that decided their fates. It was everything they did or didn't do in the months leading up to it. So that brings us to today, right now. Because frankly, the warning signs are flashing brighter than they have in a very, very long time. And let me be perfectly clear about this. This is not me predicting a crash. This isn't about fear-mongering. It's about looking at the data and realizing the conditions are ripe. And that makes getting prepared the smartest, most logical thing you can do. First up, let's look at something called the Shiller-Cape ratio. All you need to know is it's a way of measuring if the stock market is cheap or expensive compared to history. Right now, it's sitting up in the high 30s. Now, to give you some context, the long-term average for this thing is about 17. The last time we saw it this high? Right before the dot-com bubble burst back in 2000. It's basically the market's way of saying, hey, things are getting pretty pricey in here. And check this out. The top 10 biggest stocks in the S&P 500 make up about a third of the entire index's value. You've got just a handful of companies, your Apples, your Microsofts, your Nvidias, accounting for almost 30% of the whole thing. That is even more top-heavy than it was at the peak of the dot-com bubble. So when you buy a simple S&P 500 fund, you have to realize you're not nearly as diversified as you might think you are. And if that's not enough, just look at what Warren Buffett is doing. His company, Berkshire Hathaway, is sitting on a mountain of cash. We're talking hundreds of billions of dollars. And for a while now, he's been selling more stocks than he's been buying. Now, he's not doing this because he's scared. He's doing it because he's a calculator. He's looked at the prices and decided that, for now, holding cash is a smarter bet than buying overpriced stocks. You know, when arguably the greatest investor in history is choosing to sit on the sidelines, you should probably pay attention. Okay, let's bring this out of the world of charts and into the real world. I want to tell you about a real couple. We'll just call them Arkin and Vizia. Their story is the perfect and painful example of how not having a plan forces you into a spiral of terrible emotional decisions when a crisis actually hits.
So here's their snapshot. A combined income over $100,000. Sounds pretty good, right? But you peel back one layer and you see the problem. They've only got about $4,000 in savings, but they're carrying $14,000 in credit card debt at a soul-crushing 21% interest rate. And Arkin's 401k? It's just sitting in whatever default fund his company picked, which, surprise, surprise, is loaded up with those same big tech stocks we were just talking about. They were standing on a financial trapdoor.
And here's how it all fell apart, like dominoes. February 2020, Arkin gets furloughed. In just 3 weeks, their tiny savings account is completely empty. By March, with the market on fire and hitting rock bottom, they felt like they had no other option. They cashed out their 401k, getting slammed with taxes and penalties. And the worst part? Because they sold, they missed the entire unbelievable market recovery that started just a few days later. They sat on the sidelines and watched it roar back 114%, capturing absolutely none of it. Just a brutal, brutal sequence of events.
Now, I'm not telling you their story to make you feel bad. Under that kind of pressure, anyone might make the same choices. But it's proof of why having a plan before the pressure hits is so incredibly critical. So here it is. This is the antidote, the 5-step playbook designed to make sure you are never, ever in their shoes. This is how you build a financial fortress.
It's simple, but it is powerful. 1. You build your cash cushion. 2. You destroy high-interest debt. 3. You rebalance your portfolio. 4. You automate your investing and you do not stop. And 5. You learn how to weaponize your Roth IRA. So let's dig into each one.
All right, let's start with the absolute bedrock, your emergency fund. I know it can sound like a boring beginner tip, but it's not. It is the single most important piece of your financial life. It's the firewall that separates a market crash being a catastrophe from it being just an interesting number on a screen. So what's the goal? 6 months of your essential living expenses sitting in cash. Let's say your bare bones budget is $4,500 a month. That means you need $27,000. But here's the scary part. The median savings account in the US has about $8,000 in it. We're not talking about being a little short. We're talking about being in a completely different ballpark. The good news is, right now, high-yield savings accounts are paying you 4 or 5% interest just to hold your cash. So get that cushion built and make sure it's working for you.
Okay, step 2. I need you to completely change the way you think about paying off debt, like credit cards. This is not an expense. It is, without a doubt, the single best, guaranteed investment available to you on planet Earth.
Just let this sink in for a second. When you pay off a credit card that's charging you 22% interest, you are effectively giving yourself a guaranteed, risk-free, tax-free 22% return on that money. Tell me, where else can you find an investment that promises that? You can't. It's not just a good idea, it's a financial cheat code. And this chart says it all. The stock market, on average, might give you about 10% a year, with a whole lot of risk. Paying off that credit card debt gives you more than double that return, with zero risk. The math here is just undeniable. So, your mission is to attack any debt with an interest rate over, say, 6% with everything you've got. The only exception? You should always contribute enough to your 401k to get the full employer match. That's a 100% return, and you just never ever pass that up.
All right, on to step 3. Be honest. When was the last time you actually looked inside your 401k? I don't mean checking the balance. I mean looking at what funds you're actually invested in. If the answer is, I have no idea, you could be sitting on a ticking time bomb of hidden risk. Here's a really simple rule of thumb to get you started. Take the number 110 and subtract your age. That's roughly the percentage of your portfolio that should be in stocks. So if you're 35, you should be around 75% stocks. If you're 50, closer to 60%. And to deal with that tech concentration problem we talked about, you might want to look at something called an equal weight S&P 500 fund. It owns the exact same 500 companies, but it gives each one an equal slice of the pie. It's a fantastic way to smooth out the ride.
Now for a step that is going to feel completely and totally wrong when the time comes, but it's one of the most powerful things you can do. When the market is in free fall, every single instinct in your body is going to scream at you to stop investing, or worse, to sell. You have to fight that urge with cold, hard discipline. Just look at this data from JP Morgan. It's incredible. If you put 10 grand in the market and just left it alone for 20 years, it would have grown to $72,000. But if you tried to time the market and missed just the 10 best days, your return gets sliced in half. Miss the best 30 days and you're barely left with more than you started with. And here's the kicker. The market's best days almost always happen right in the middle of a crash or in the first few days of a recovery. If you're waiting on the sidelines for things to feel safe, you've already missed the entire game. All right, our last mechanical step, and this one is a game changer. A down market is, without a single doubt, the absolute best time to either contribute to or convert money into a Roth IRA. See, with a Roth, you pay the taxes on the money up front, and then it gets to grow 100% tax-free for the rest of your life. So if you're contributing when the market is down, you're basically buying stocks on sale inside that amazing tax-free account. Even better is something called a Roth conversion. That's where you move money from a pre-tax account, like an old 401k, into a Roth. Now, you have to pay income tax on whatever you convert, but if you do it when your portfolio has been crushed by 30%, well, you're only paying tax on that much smaller amount. It's like getting a massive discount on a lifetime of tax-free growth. Okay, we've gone through all the steps, the nuts and bolts. But if I'm being honest, that's the easy part. The hardest part of surviving a market crash has nothing to do with your money. It's all about what's going on between your ears. It is a psychological war, and that's where most people lose. There's this Nobel Prize-winning concept called loss aversion.
And what it proves is that the pain you feel from losing $1,000 is more than twice as powerful as the joy you feel from gaining $1,000. This is not a weakness, it's not a personality flaw, it's hardwired into our human brains for survival. And you cannot reason your way out of it when your portfolio is bleeding out. The only way to win is to prepare for it ahead of time, by having a rock-solid plan that you commit to right now while everything is calm and rational.
So here's the bottom line. The people who come out of the next crash wealthier won't be the geniuses who predicted the exact day it would happen. Nobody can do that. No, the winners will be the people who simply did their homework before the test was handed out. They built their cash cushion, they killed their toxic debt, they rebalanced their portfolio, and they just kept investing, month in and month out. A crash isn't an ending. For the prepared person, it's the beginning of the best chapter yet. The only real question is, will you be ready for it?